Preparation of financial statements. So, what do you mean by preparation of financial statements? Preparation of financial statements. Here, financial statements includes profitability statement and a balance sheet. Profitability statement is nothing but your profit and loss account, or else you can call it as an income statement also. Okay. So what it is? It comprises of the expenses and income which the business has incurred during that complete accounting period. It includes whole business activities related transactions, income and expenses booked in that statement for that specific accounting period. And second is a balance sheet. Balance sheet will give you up that periods whatever the as on the last date on which you are preparing the balance sheet, the status of your assets and liabilities, where you are standing as on that day, what are the resources of fund and what are how you have applied the funds, whole the assets and liabilities owned by the owners or owed by the owners, that position you can understand from the balance sheet. So we will be preparing these two under financial statements. In that we prepare trading account. So what is the trading account? Trading account actually in vertical format is it has been combined with the profit and loss account or income statement, which will be coming later in the other part. Here we will in a T form balance sheet. In the T form we are saying means horizontal form our balance sheet P&L account what we are learning here. We will be preparing something called trading account also. Trading account is normally prepared by the business which deals in goods, purchase, selling of goods, because trading account will be comprising of only the stock and the goods movement during that accounting period. So what it will be appearing? So in the trading account on the debit side you will find first the opening stock. What is the opening stock? Opening stock is the finished goods in which the business is trading. So opening stock is that at the start of the accounting period what was the stock lying with the business, that will be shown on the debit side of trading account. And then purchases during the year. So whatever the purchase, so it can be cash or credit purchases, anything, plus all the cash and credit purchases you add minus any returns or minus any goods taken away by the proprietor if it is a sole propriety business, or if it is a company or anything, whatever the goods free sample distributed. So whatever is going out of the purchases we will reduce it. So we will be showing here the net purchases. Third is the direct expenses. Direct expenses are those expenses which are incurred for the specifically for the purchases at the time of purchases. So it includes freight, octroi, wages, which we are incurring and which has directly relation to the purchases and which are mandatory for purchases. Okay. And these are the debit side items. If the business is making profit, then you will see on the debit side gross profit. Then what is shown on the credit side? Credit side you will be seeing revenue. What revenue? The sale of goods revenue. So sale from the goods sale, because trading account deals with all the movement of all the transactions related to the movement of goods. So it should be clearly here appearing the sale of that goods. Okay, not the other income. Directly related to that goods in which the business is indulged in. Okay, so that revenue will be booked here. So that revenue depends on whichever, like if it is a construction business, then according to AS7. If it is in any other cases, then AS9, which is revenue recognition standard. So accordingly we will book the revenue as per that accounting standards. Okay, so this sales revenue is that revenue, not the other income, purely related to business transaction or business activity. Whatever revenue is that will be booked here. Then the last day, as on balance sheet date, whatever the stock, finished goods stock lying with the business, that will be appearing on the credit side of trading account. Now, how to value it? There is an AS2 which says you should value the stock at cost or NRV. NRV is net realizable value, whichever is lower. So, cost or net realizable value, whichever is lower, at that you will show the closing stock. And if there is a loss, then it will be appearing on the credit side. So gross profit and gross loss will be the balancing figure depending on which side is heavier. Like when you prepare the trading account, it will look like this. Trading account for the year ended 31st March or 31st December 2020. Like that you will write debit and credit side. This is a debit side. So what will come? Opening stock, purchases. Okay. And on the credit side it will be sales, closing stock. Okay. Opening stock means your finished goods, they are saying. Purchases will be net, so all purchases add up, less purchase returns and any others will reduce it. There can be wages also. Third item you may come across. Fourth item you may come across direct expenses, which they have not shown. It may come, this depends. This two is short it will be there. This also will be surely there. Wages and direct expenses may not be there in trading account. Okay, after entering these all items, you will be closing your trading account. If your credit side is heavier and debit side is less, we will get gross profit, which is a balancing figure. Means the business has made a profit because credit side is heavier, means income side is heavier. Expenses are less, income is heavier. So we made a profit. If debit side is heavier, means expenses are more, income is less. So it is a loss. Okay. So accordingly, the balancing figure will be gross profit or gross loss, whichever is balancing figure will be, and you will close your ledger. This gross profit will be later carried on to P&L account, which we will be dealing later. Okay.